Corporate landlords such as Blackstone are doing strategic defaults on commercial properties across America, resulting in colossal write-downs in value, with commercial property prices collapsing by 22% over just the last 15 months, with apartment and office buildings getting hit the hardest, with values down 30 to 35% from peak. And this commercial property crash, everyone, it's something that could cause a massive contagion effect in the economy in 2024 that causes commercial owners to close up shop and banks to shut down. With Business Insider reporting that US banks could get slammed with another 160 billion in losses as commercial real estate faces its biggest crash since 2008, which is a scary, scary prospect, everyone. There's lots of people out there right now who think the economy has dodged a bullet and that we won't experience a recession in 2024. But the more research that I do across different sectors of the economy, particularly here in commercial real estate, I'm seeing huge issues developing, because when you see big companies like Blackstone, the largest alternative investment manager in the world with over $1 trillion in assets, when you see Blackstone just begin to walk away from properties, it's got to cause you to think that something is up. Because for instance, Blackstone is now nearing default on a huge office center in Las Vegas that's sitting 42% empty. This $1.4 million square foot facility is called the Hughes Center. You can see it's actually located just to the east of the Sphere in Las Vegas, the brand new entertainment complex they built. However, despite this good location, there's a problem, and it's the fact that these office buildings here are nearly 50% empty. As a result, Blackstone stopped making payments on their $325 million loan tied to the office park, which is now in special servicing, which is what happens right before foreclosure. I was shocked at just how many articles I found of big companies like Blackstone just walking away from huge $100 million commercial real estate properties. Here's another one. Blackstone completely writes off Playa District office campus in LA, which has $483 million in loans on it. Well, given the challenges facing the property, Blackstone began writing down this property 3 years ago and has now completely written it off. Or how about this one? Blackstone seeks to surrender Club Quarters Hotel in San Francisco. They defaulted on a $274 million loan tied to these hotels in Chicago, Philly, Boston, and San Francisco. They're now negotiating a deed in lieu with the mortgage lender, which allows Blackstone to transfer the property to the lender and relieve it of all responsibility to pay the mortgage debt. And so what is going on here, everyone? Why is Blackstone walking away from all these commercial real estate deals? Why are commercial property values plunging all across America, not just in office buildings, but also in apartments? What is going on, and what is this going to mean for the economy in 2024? Well, folks, it's not good, because anytime you see this colossal collapse in valuations and destruction of equity and wealth, there's going to be a knock-on effect, a contagion effect throughout the economy. And I believe the way that that contagion effect is going to play out in 2024 and beyond is through the banking system. Because when there's these huge losses, someone is holding the bag. Someone is losing lots and lots of money, and that someone is the banks in America. As we can see here, according to data from the Federal Reserve Bank of St. Louis, there are $2.9 trillion in commercial real estate loans on bank balance sheets today. You can see the amount of commercial real estate loans, which covers offices, apartments, retail, hotels, industrial, that has surged over the last 4 to 5 years to a record high, almost 50% higher than the exposure these banks had in 2008 at the peak of the last bubble. And so what I fear is going to happen is that as more of these commercial landlords just say, hey, we can't afford to pay the interest on our apartment building loan because interest rates go up, so here's the property. As that happens more and more, it's the banks who are going to be eating those losses and having to foreclose on the properties at valuations well below the mortgage amount that they loaned on the property. And when that happens, when the bank has to foreclose and the underlying value is less than the mortgage, that triggers problems, because all of a sudden the bank now is going to be facing liquidity issues, solvency issues. They're going to have to start reporting losses on their income statement, and they potentially have to deal with depositors yanking money from the banks. And if that happens, we could see banking crisis 2.0 develop across the banking system. You guys probably remember 8 to 9 months ago, we had a mini banking crisis. We had 2 to 3 banks shut down in America. There were bank runs. The depositors started yanking their money, caused a big scare. It actually caused a liquidity crunch in the economy. Monetary credit dried up, but then the Fed kind of came in and papered it all over. Well, maybe it's not all over. Maybe this commercial real estate crash, which is happening right now, maybe that could trigger even more of a banking crisis in 2024, with the National Bureau of Economic Research recently putting out a paper that assessed these risks. They found that right now, 14% of all commercial real estate loans are in negative equity, and 44%, almost half of all office loans are in negative equity. And that if we only have a 10 to 20% default rate on CRE loans, a range close to one that we saw in the Great Depression, that would result in anywhere from 80 to 160 billion in additional bank losses, which could cause as many as 300 smaller regional banks to join the risk of solvency runs. And make no mistake, everyone, Jerome Powell and the Federal Reserve, they are paying attention to these risks in the background. They might not be talking about it in their press conferences all loud because they don't want to scare people, but they are paying attention to these risks. Their economists are looking at this. And I think one of the reasons why Jerome Powell and the Federal Reserve pivoted to start signaling interest rate cuts in 2024 is because they see what's coming on the horizon for the commercial real estate sector and the banking sector. Because this is something that's like a slow motion freight train. And their idea is, okay, if we cut interest rates a couple times next year, maybe we'll relieve some of the pressure on the banking system, on the commercial real estate sector. Maybe we'll be able to avoid an outright crisis. However, I'm not so sure, everyone. I think the wheels are already in motion on this because the value of commercial properties are just plunging right now. It's almost hard to fathom. With a new report from Green Street, commercial real estate analytics company, showing that the value of office buildings has gone down. Get this, everyone, 60% in San Francisco year over year, 48% in Chicago, 48% in San Jose, 45% in Philly, 45% in LA, 37% in Dallas, 37% in New York, and 31% in Boston. These are real declines. This is a real crash in the office sector happening as we speak. Hundreds of billions of dollars in equity getting wiped out right now. And of course, we know why office values are plunging so much. Everyone, has a lot to do with the pandemic, the advent of remote work. Lots of people are still working from home, even though, there's been some companies calling people back into the office. We're still only at about 50% office occupancy of people going in compared to what it was before the pandemic. And so due to that, the tenants of these office buildings, they don't need as much space. They don't need to renew their leases, with the office vacancy rates increasing as a result. A lot of these buildings, they're just sitting empty, especially in a city like San Francisco, where the office availability rate is now 35%, everyone, meaning that of the 90 million square feet of offices in San Francisco, around 30 million are sitting vacant. Additionally, we can see a market like Nashville has huge vacancies. In Nashville, there's 48 million square feet of office. Well, 27% of it is currently available. That's well above the US average 23% availability rate. Keep scrolling up. We can see Houston is one where there's 200 million square feet of office. Well, 30% of it is vacant. In Denver, there's a 30% vacancy rate. In Dallas, there's a 30% vacancy rate. In Austin, there's a 30% vacancy rate. And even in Atlanta, there's a 32% office vacancy rate. And so those vacancy rates are a huge problem, something that is not going to get better in the near term, everyone, because there's kind of a new normal in terms of how much office space companies need post-pandemic. It's lower than it was before the pandemic, but there's also a concerning drop in the amount of job postings from corporations who need office workers. According to a new report from Avis and Young, you can see that office job postings are down 21% from their pre-pandemic level, while office employment is up by 6.5%. So we have employment still up, but job postings way down, particularly in industries like consulting, media, banking, law firms, and tech, where there's been a 33 to 50% drop in office job postings over the last year and a half. And note, folks, these job postings include remote jobs. So this is for jobs that could be done remotely or in an office. The postings are way down, which suggests less of a need to lease office space in the future. And folks, I can't help but wonder, when is the shoe going to drop on the economy from all of these issues that are developing and bubbling up in different sectors. Like in this video, we're talking about the huge crash in commercial real estate, the surge in mortgage defaults, the issues that are going to be in the banking sector. Like that's just one example of problems going on. In my video last week, I talked about how companies like FedEx are having huge problems because there's a freight and trucking recession. And so far, we haven't seen kind of these isolated pockets of real stress spill over into the economy, but I wonder if they could soon. Because I was doing some additional research for this video on small businesses. Everyone, small businesses, a big part of the US economy, and they are now experiencing problems as well. Because according to the Small Business Optimism Index, we're seeing some very concerning trends with small businesses that aren't really going reported in the mainstream news. But when you look at the data, you're saying to yourself, uh-oh, could something be coming here in 2024? A lot of them are saying, hey, the incomes and the revenues, they're collapsing. With the trends in small business earnings now hitting the lowest level that we've seen since the pandemic and that we've seen since 2008. This is a question that this survey asked small businesses, asking them over the last 3 months, are your earnings higher or lower? And in the most recent survey, 32% more small businesses reported lower earnings than higher earnings, which as you can see is close to the worst reporting on record. Now this small business survey comes from the National Federation of Independent Businesses, and they've been conducting this survey of small businesses across America for almost 5 decades. And we're seeing nearly the worst level of all time in earnings trends for small businesses. So maybe you say to yourself, wait a minute, is the economy actually not doing as well as the mainstream financial reporting and the big mega cap stocks are suggesting? Well, again, let's see what the National Federation of Independent Businesses has to say. Well, they're saying that the net percentage of small business firms increasing employment has been negative since March, with more firms decreasing jobs than adding them, which stands into stark contrast with the BLS jobs data of the last few months, which paints a more rosy picture of the economy. And so we continue to see kind of a divergence, everyone, between like what the US government is reporting in their unemployment statistics and their retail sales figures versus what independent organizations and small businesses and many companies and people are experiencing in the economy. And there could be a lot of reasons for this discrepancy, everyone. Some people think that the government fudges the employment and retail sales figures. I personally don't think that's the case. Rather, I just think the economy operates on a significant lag and that it takes time for higher interest rates, pessimistic sentiment, contraction in the money supply. It takes time for those things to filter through to the economy. And what I fear is that there's lots of people out there right now who are buying stocks, buying houses on this idea that everything is going to be rosy in 2024, but I really feel that it won't be, everyone. Now, speaking of Blackstone, everyone, an interesting question that I bet is on a lot of your minds out there is Blackstone going to be buying single family houses in 2024? Because Blackstone, they're one of the biggest corporate entities out there, and they were actually the entity that started the big corporate home buying binge back in 2012. Back in 2012, at the bottom of that last housing crash was when Blackstone started buying houses for pennies on the dollar. For instance, back in 2011, August 2011, they raised a fund called BRP 7. It was a $13.5 billion fund, of which $1.4 billion is still available. So they allocated most of this capital already. This was the fund that ended up buying a lot of the single family homes in America, BRP 7. Now, interestingly, you can see they raised a new fund in August 2022, a little over a year ago, called BRP 10. That's a $30 billion fund, of which they still have $29 billion left to deploy. And this fund, it was the largest ever for a real estate drawdown fund. So is Blackstone going to use some of that new money to go buy homes again? Well, one thing about these corporate investors, whether you like them or don't like them, and I think most people don't like them, is the fact that they are motivated by one thing: making money. And back in 2012, when Blackstone bought a lot of homes, you could make a ton of money in the housing market because the cap rates and the yields were absolutely insane. For instance, across Phoenix, these investors were buying homes at 16% cap rates back in 2011, meaning they could buy a house for 77 grand and get 12,000 in rental income right away. That's an amazing return. However, fast forward to today, and they're only getting a 5% return by buying homes. Not nearly as good, not nearly as compelling. And so for now, I don't think Blackstone is going to use the money in their new fund to buy single family homes because the returns simply aren't high enough or exciting enough. However, if home prices were to drop by a lot and go down by 30 or 40% in different neighborhoods, maybe then the corporate investors like Blackstone are going to begin buying single family homes again. But for now, they seem to have shifted their focus more to assets like logistics, student housing, and data centers. And this shift in the assets that Blackstone is invested in has seemed to be good for their stock price. Despite all the defaults on the office portfolios and the hotels and some of the apartment buildings, Blackstone's stock is still through the roof, trading at $133 a share, which you can see is nearing the peak that occurred during the pandemic. You can see Blackstone's stock is up 32% over the last 6 months, trading at a PE ratio of 51, which I don't know, folks, that seems a little high. A little richly valued means that basically Blackstone's stock price, they're assuming a lot of future growth in earnings. And so we'll have to track kind of the future of the economy and the real estate market in 2024, because if we keep seeing these headwinds pile up, I think we could see downside for stock prices, home prices, real estate prices more broadly. And to see more of my analysis and predictions for what's going to occur in the economy in 2024, hit that join button below and become a channel member. And you will get access to exclusive videos that are only available to channel members of me digging even further into this data on the economy and the housing market, including my predictions for where home prices are heading, as well as more coverage of different sectors like commercial real estate and the stock market. The cost of hitting that join button and becoming a channel member is only $5 a month, and you can cancel at any time. On the screen right now is a link to a channel member exclusive video I did just a couple weeks ago, so check it out and hit that join button. Note, to access the $5 a month membership, you need to sign up on your computer. If you sign up on your phone, you're going to get charged $7 a month due to fees that the smartphone manufacturers take. So try to sign up on your computer so you can get that cheaper $5 a month price.